Welcome back to the channel where we uncover the mysteries of the stock market, focusing on the often misunderstood world of hard-to-borrow stocks and potential short squeezes. Today, we're diving deep into fascinating micro-cap that's been lighting up our screeners, Global Interactive Technologies Inc., trading under the ticker GITS. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Global Interactive Technologies Inc., or GITS, operates in the communication services sector, specifically within internet content and information. This South Korean-based company, through its subsidiary, focuses on technology-driven platforms. Their flagship product, Fanning, is a digital fan engagement platform designed to support online fan communities, content discovery, sharing, and user interaction. Currently, GITS sports a market capitalization of just $6.1 million, firmly placing it in microcap territory, which often comes with higher volatility and unique dynamics. Its estimated float, the number of shares available for public trading, stands at a tight 2.4 million shares. Keep that small number in mind, it's a crucial detail for what we're about to discuss. What is cost to borrow and why it matters? So, what exactly does it mean when a stock is hard to borrow? It refers to a situation where the supply of shares available for short sellers to borrow is scarce, leading to a high cost to borrow, or CTB fee. This fee is an annualized interest rate that short sellers must pay to borrow shares before selling them. When this fee skyrockets, it's a clear signal that demand to short the stock is high, or, more importantly, that the supply of borrowable shares is extremely limited. Why does this matter? Because a high CTB means significant ongoing costs for short sellers, eating into their potential profits and increasing their risk. These annualized fees can even exceed 100%, turning a short position into a very expensive wager. Why this stock is hard to borrow right now? Now let's talk GITS specifically. Our screener flagged GITS with an absolutely staggering cost to borrow fee of 932.3% annualized. Highlight CTB, let that sink in, 932.3%. This means anyone currently short GITS is paying nearly 1,000% interest on an annualized basis just to hold their position. This is an enormous daily expense for short sellers. While we don't have current data on shares available to borrow, the sky-high CTB strongly implies extreme scarcity. Combine this with GITS's tiny estimated float of only 2.4 million shares, and you have a recipe where supply-demand imbalances can have an outsized impact. Today's volume for GITS was just 41,300 shares, well below its 30-day average volume of 92,656 shares, giving it a relative volume of only 0.4x average. Low liquidity can amplify price movements, especially if buying pressure emerges. Our internal composite squeeze score for GITS currently sits at 42.5. This isn't screaming imminent squeeze score, but it indicates a noteworthy combination of factors that warrant attention. However, it's critical to remember a high cost to borrow does not guarantee a short squeeze. It can also signal that short sellers have very strong conviction and are willing to pay these exorbitant fees, believing the stock will fall even further. Squeeze mechanics explained. For those new to the term, a short squeeze occurs when a stock's price rapidly increases, forcing short sellers to buy back shares to close their positions. This buying action then pushes the price even higher, trapping more short sellers and creating a cascade of buying pressure. It often starts when borrow fees become too high, or the stock price begins to move against the short sellers, triggering a desire to cut their losses. When they buy back shares, it adds demand to the market. With a small float like GITS's 2.4 million shares, even a moderate amount of forced covering could have a dramatic effect due to limited supply. Dilution risk check. One critical factor that can negate a short squeeze, even with a high cost to borrow, is dilution. Dilution happens when a company issues new shares, increasing the total supply and often putting downward pressure on the stock price. This can provide short sellers with more shares to cover their positions or allow new short sellers to enter, effectively absorbing any potential buying pressure from a squeeze attempt. The good news for GITS? Our checks found no recent dilutive SEC filings such as -1s, -3s, or 424 BS in the last 90 days, nor any recent reverse splits in our look-back window. This means the immediate threat of new share issuance undermining a squeeze thesis appears minimal for GITS at this time. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should you keep an eye on with GITS? Let's look at recent price action. The stock has been trending downward, with today's change at minus 1.78%, a minus 13.99% drop over the last 5 days, and a minus 20.19% decline over the last 30 days. To price chart, this downtrend is typically what short sellers want to see, making the 932.2% CTB even more intriguing. Watch for any significant increase in trading volume, especially if accompanied by positive price action. A spike in volume above its 30-day average of 92,656 shares could signal increased interest or, more importantly, short covering. Also, keep an eye on any potential public data regarding borrow availability. A further shrinking supply would be a major catalyst. Technically, look for GITS to establish a base or show signs of reversal from its recent downtrend. Highlight potential support. Global Interactive Technologies, Inc. GITS presents a fascinating case study with its microcap status, tiny 2.4 million share float, and that eye-popping 932.3% annualized cost to borrow. While the stock has been trending down recently, the extreme cost for shorts remains a significant factor to monitor. Remember, a high CTB is just one piece of the puzzle, and it doesn't guarantee a squeeze. Always conduct your own thorough due diligence. If you found this deep dive into GITS informative, make sure to like this video, subscribe to the channel for more unique insights into hard to borrow stocks, and let us know your thoughts or questions about GITS in the comments below. We love hearing from you.